Well, hello and welcome to this special program on Brexit and the impact on markets. And I have a special guest with me, Desai of Morgan Stanley. Mayhem in market yesterday, at least for starters. But by the evening session, things cooled down for us, for FTSE, though the Eurozone was down quite a bit and US market ended down about 4.5%. A lot of people asking, is this similar to 2008? And are we in for prolonged uncertainty in the market? Your take on that?
Okay, so there are two questions there. So is it 2008? No, it's not. 2008 was a full-blown global financial crisis with global banking sector in deep trouble. This is nothing compared to that. In fact, there is no crisis here. There's an event that has happened which has ramifications on the growth of certain parts in the world. What's in debate here is the growth that Europe will have. And there's a possibility that Europe and the UK both slip into a recessionary situation in the next 2 years because of the adjustments they have to make on two counts. One is the trade agreements that flow between the two parts, and the other is the labor arrangements. So today, these two zones have free-flowing trade and labor, basically porous borders. That porosity will end. By the way, it ends in 2018 October. So it is not an immediate thing anyway, because by the time they complete all the work around this, it will actually only happen a couple of years later. So it raises the possibility that we may have a recession in what is a pretty large part of the world economy, which can then have a consequent impact on growth elsewhere. Now, put it into context. The world is dealing with a very large indebtedness. In the developed world, China, so basically Europe, Japan and China are dealing with large indebtedness. It's an aging population, especially Europe, Japan, and growth has been anemic. Now, when you put that on top of this, it raises the question about whether growth will recover in the next 3-4 years for the world. And that, I think, is the debate that markets are dealing with. As regards the share price correction today, I mean, in most parts, the markets gave up what they had gained in the preceding few days.
Which they expected in Remain, that was given.
So it was in anticipation of Remain. What they gave up was that, okay, Remain didn't happen, Brexit happened, so they gave it up. We've really not seen a net loss in most markets, maybe some markets, maybe some asset classes like the UK pound, which has seen probably some fall. Even I think the UK's pound is back to where it was in February. So it's not actually made a new 3-month or 4-month low. So to that extent, I think the markets are adjusting elevated expectations about the outcome, and that's what the adjustment was.
So that's my follow-up question. In that case, is there a risk that what we saw today was just giving up of the Remain rally, and the actual impact of Brexit is something that the market will have to deal with, not just for the next week, but for a protected period of maybe 3 or 4 months till this uncertainty is out of the way? At the end of the day, we'll have to figure out what UK's exit would mean for the euro.
So Anuj, I would say that this depends primarily on how policy response takes place. I think that if there is a sense of panic in the marketplace and corrections in asset classes last beyond a couple of days, it would not be a bad thing to anticipate that there will be a coordinated monetary response from the 3 big central banks. And then the peripheral central banks will also participate to ensure that we don't hit a liquidity squeeze.
Would that be enough, or will we require a fiscal sort of measures as well, apart from the monetary measures?
So I think fiscal measures have not been coming over the past few years. My colleague Chetan wrote a very interesting note about this, which is, he says the distinction between the growth cycle in the world today and what happened in the 30s is that in the 30s the monetary response was coordinated with fiscal response, which is why the world came out almost in a V shape after 10 years of depressed growth rates. This time around we have not seen that fiscal response from the large economies in the world. They've been reticent, maybe because their starting point of debt was too large and the starting point of the fiscal deficit was too large. What we have seen actually is a contraction in the fisc. So yeah, that's a possibility. I mean, if I cannot really speculate on that, but if it happened, I think it will be very positive for equities. So the market's near-term reaction will be dependent on how policymakers react. In the medium term, I think certain businesses will hurt because there is a likelihood that the next 2-3 years will see slow growth in Eurozone, and therefore businesses that depend on that, exporters to Europe, for example, may hurt. By the way, producers inside the UK may have already got their bonanza.
With the pound.
Because if pound remains this weak, then basically you got an upfront payment for the slowdown in growth that will happen, which is probably why the UK stock markets will not hurt as much as say
Eurozone. Are you saying that that for example Tata Motors it fell 10%? It was just more of a panic reaction, and some of these companies which are getting revenues from the UK actually stand to benefit, and any fall actually is a buying opportunity.
Okay, I'm not going into specific names, but no, let's pause for a moment. Companies that have exports into Eurozone may have to see their earnings adjust a bit with a 2-3 year view. Okay? Companies that have production facilities in, say, the UK, okay, may not hurt as much because of the currency markets reaction. So there are two different things here, which is that I think the 2-3 year view, Morgan Stanley's view is that there is a rising specter of a recession in Europe and the UK. And therefore, if you are selling to those markets, if you are servicing consumers or corporations in those markets with your products out of India, you may see a slowdown in demand, which is why you may have to cut back. So I think, pronounced impact is on IT services. Because a lot of IT services companies in India actually sell receive a large portion of their revenues, sizable revenue portion from Europe. And there may be a cutback in orders there if Europe slips into slower growth and recession.
Why is it so different to 2008? 2008 we had just one bank collapsing and we had financial markets in a bear market. What makes you so sanguine that this is nothing close to 2008?
No, so you should not describe it as a sanguine view. I think there is a difference with 2008. The specter of the Eurozone breaking up is a real one, and we have to deal with it if it happens, but it's not yet happened. And for sure, if this leads to several other countries leaving the Euro, then there will be a lot of disruption in the stock markets. But the difference between this and 2007 or 2008 is that in 2008, you had a universally over-leveraged banking sector that had run up massive losses. And it was a collapse in the financial system of America. There is no collapse here. Okay, it's not a collapse of the financial system that is happening. It's very different in the scale and size. And you say one bank, but actually a lot of banks had failed by the time we hit 2008 October. And then there was a massive bailout package that had to be engineered in order to redeem the US financial sector, and a lot of things have changed since then in terms of regulations. That's not what we are dealing with here today. We're certainly dealing with uncertainty. Let's not have any doubt about it. Yes. We're dealing with uncertainty. I think there are medium-term implications here. There is a risk that other countries depart the euro, and it's something that the markets will have to deal with. And there are specific stocks and sectors that will get hurt. In fact, even India's own macro, to the extent that we have some amount of exports to Europe, I think growth in those areas will slow down. So it's quite possible that India's GDP growth may be a little lower than what we may have envisaged because of the events that unfold in Europe. So I think it certainly has some impact. It should not be viewed as there is no impact, but it is not as catastrophic as 2008. Also, one more point, Anuj, is that we want to evaluate the impact on the markets, not just the macro. And the big difference between 2008 and today is the starting point of valuations, which is 2008 happened when the global stock markets were on a 5-year bull market. Yes. And valuations were elevated everywhere. Yes. Just for comparison, India was trading at 32 times earnings. Yes. Okay. We're now at 16, 17 times earnings. So it makes a difference where your starting point of valuations are. And that exuberance is not there in the market. In fact, if anything, actually take away the last 2 or 3 weeks of stock market rally in Europe because the Remain confidence had gone up. Actually, these markets have been languishing prior to that. So there's no optimism baked into the share prices outside India. With regard to India, I think we still have a few things to deal with in the near term. I would say that the rains are still developing news. Yes, we have seen a start. It's a bit of a delayed start, but it's still a developing news flow. It's not absolutely clear that we're going to get a great rainy season. And it's not about just the quantity. With regards to rain, it's also spatial and temporal distribution. So where the rain comes and when it comes.
Yes.
And this is a crucial period. I think stock prices in India are getting a little optimistic about the earnings season because of what happened in the previous earnings season, where we saw a notable uptick. So expectations are a bit higher now. We have to deal with also the events which will happen in Europe. So I would say that it's possible that we go through a period of consolidation. I say that with great care because my short-term calling on the market is woeful. But I think 8,300 on the Nifty, which we saw a few days ago, will not come back so easily.
Okay.
Yeah, I think it will take a little while to go there, and we may go a little lower before we come back. It's possible.
Okay, you normally don't make such index calls in the near term.
No, I don't. I'm just giving you as an illustration that it may not, that the near-term upside I think is going to be harder to get in this market.
Okay.
Yeah, but
at index level because of valuations as per them, or is it because of the headwinds that you spoke about in terms of?
So we have to get clear of these headwinds.
Okay.
And who knows? By the end of July, these headwinds are clear and the market could be up a lot,
yes,
right? And I'll be having egg on my face. That's a certain possibility that is there, and I can see that as well. That scenario also can be seen. I think people should not be really concerned about this.
Okay.
We are in the middle of a bull market.
Okay.
And bull markets will always have their 5-10% correction all the time. All those corrections happen to be opportunities.
Yes.
Those who can time this and those who are good at it, great for them. Those who are not good at timing should not worry about timing it and should just buy stocks, because I think stocks in India are going to CAGR nicely over the next 5 years.
Okay.
We're in the beginning of a new earnings cycle. There will be doubts that will creep in because there will be one quarter that may not be as good. But I think we're in the beginning of a cycle. I am quite bullish on the way the government has handled the economy. I think it's quite spectacular in the way things are turning around in India. It's happening slower than what we may have anticipated 2 years ago because of the headwinds from the world. Those headwinds are not going away, and Brexit has just added an extra headwind. So it just increases our challenge, which means that we have a slightly more sedate and prolonged bull market. Not a V-shaped bull market, but a kind of a U-shaped bull market. But it's nevertheless still a bull market. So you want to be in stocks. And Anuj, you know what? I keep looking at how much households in India own stocks.
Yes.
The last calculation is $300 billion. They have $1.8 trillion in gold. They're all hedged against Brexit. so they're all hedged. They were all in the money on Friday. The country as an aggregate was in the money on Friday because they own 6 times or 5 times more gold than they own stocks.